Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology, and financial advice. Hosted by Abraham Okusanya, you can expect raw honesty, critical analysis, and energetic interviews. Here is your host, Abraham Okusanya.
Hello and welcome to Retirementals. It's great to have you all here today. Oh boy, am I excited about my guest today. He is the grandfather of the Sustainable Withdrawal Rate Framework. I am talking about none other than the legendary Bill Bengen. Hi, Bill. Welcome to Retirementals.
Abraham, thanks for having me. I'm looking forward to this.
It's great to have you on the show, and I am really looking forward to our conversation today. I've got a very long list of topics that I want us to explore, all under the Sustainable Withdrawal Rate Framework. But before we dive right in, I want to go back into your background a little bit and understand a little bit more about how you got into the profession. There's a joke I tell every time I give a presentation, and then of course your name comes up in my presentation. I say things along the lines of, Bill Bengen studied at MIT. He wanted to join the US space program, but for whatever reason, he wasn't accepted into the program. So he did the next best thing and became a financial advisor. And everybody likes that joke. So tell us, Bill, how did you get into the profession?
Well, after we sold our family business in New York, we moved out to the West Coast, California. I took about 6 months off and just looked at what I wanted to do, because I thought 40 years old was awfully early to retire. And I looked at a number of interesting things, computer work, writing fiction, and I realized that I, with my financial circumstances, would need financial planning guidance anyway. So I said, why don't I teach myself all these things, go through a program and become a financial advisor myself and help people with it? Because it was something I could do out of an office in my home, which was very appealing to me. I really didn't want to commute anymore. And decided on that and went through the CFP program and the master's program in financial planning. And that's how it all began.
Wow. So this was in the 1980s, late 80s?
Yeah, late 80s, early 90s, yes.
Incredible. So you got into the program, you became a financial advisor. And what led you to this research around what is now known as the safe withdrawal rate, or the 4% rule?
Sure. And we didn't even have a name for it back then. Right. Safe withdrawal, sustainable withdrawal rates, those are all terms to come. I had clients who were coming to me and were starting to think of retirement, even though it was 20 some years off. These were the early baby boomers, such as myself. And they asked me two questions I didn't have answers for. How much will I be able to take out of my retirement savings when I retire? And, how should I set up my investments, to maximize, that return? And I looked through all the material I had for my CFP courses, my master's program. I researched it. And of course, in those days, you didn't have the internet to the extent we have today. Right. So it was a lot tougher to do that research, but I couldn't come up with anything. So I decided to do the research myself. I grabbed a book of containing investment returns, inflation, fired up my trusty Lotus spreadsheets, and got to work trying to find answers myself.
So this is incredible, though, that at the time, financial planning was already, an established profession, and you went through, what even today would be considered a very rigorous academic program, i.e. your CFP, a master's degree, and at the time, there was nothing to, on, what did people do at the time in terms of drawing money from their retirement portfolio?
That's a good question. At the time, people pretty much went by rules of thumb that were given to them by other people, friends, financial advisors, without any real, theoretical or empirical basis for doing so. Some people would say, "Oh, you're retired now. You can't afford to be in stocks, so you got to go to bonds, all bonds." Or they would say, "No, my goodness gracious, you have to have a lot of stocks in your portfolio, else you won't be able to withdraw money." And then they would say 6%, 7%, 3%. It was all over the lot. And that was not a satisfactory background for me to use to advise my clients.
Yeah, so you began the research. Can you just sort of, for a layperson, can you just go through the process, what you did with the data? You had the data going back 1926 at the time. What did you do? What kind of data set, and what is it? How did you arrive at your results?
Essentially, what I did was reconstruct the portfolios of retirees beginning, in 1926 and on up, through as far as I could, that had 30 years of experience. I gave them large cap stocks. I gave them intermediate term government bonds, and I gave them the actual inflation rate that they experienced. And I just put them in a mix and let the portfolio perform as it would have if they had invested it basically in low cost index funds. And in each case, then I was able to stress test those portfolios with withdrawals, starting with a high rate, let's say 7%, and bring it on down and try to find out where the portfolio broke down, where it failed to last 30 years, which was really an interesting experiment.
And what did you find?
Well, I found that in the worst case, the unlucky retiree retired, let's say in early 1969, late 1968, they could only take out, my original research was about 4.2%, but I later upgraded that to 4.5%. And then their money would run out after 30 years. And they were unlucky because they ran into two big bear markets early in retirement, 69, 70, 72, 73, or 73, 74. Which is the first thing you want to avoid if you can do it. Pick your retirement carefully. And the other was that they encountered very high inflation. And most people aren't aware how damaging inflation is to a retirement portfolio. If we are increasing our withdrawals for inflation each year, and inflation is high, we are really jacking up those withdrawals every year. And unfortunately, that's fixed. I mean, bear markets come and go. But once you add 10% a year to your withdrawals and it's locked, it really starts chewing up your retirement investments very rapidly.
And where did this idea of the worst case scenario come from? Because you ran every 30 rolling period. Sure. I remember reading your papers on this. Initially, you were using quarterly data, and or you used annual data and then maybe moved to quarterly, something along that line. So you ran every rolling 30 odd year period, and the 1969 retiree turned to be the worst case scenario. Why the worst case scenario? Why not, some might say, well, the 10th percentile, for instance.
Sure. I created a chart where I had a bar for each retiree. And I started with, 7%, brought it down. And you could see in the 60s and 70s was the period that was most troubling to retirees. And I felt that if people wanted to be absolutely safe, we're talking in context of historical experience, I can't predict what's going to happen. They could take this 4.5% and use it. And no matter what happened, as long as history pretty much repeated itself into the future, they would be okay. And that was very reassuring to a lot of people to know that there had been a rate that all retirees were able to get through retirement without having to make any adjustments.
Brilliant stuff. So you compiled your research. You wrote a very powerful article, which was ultimately published in the Journal of Financial Planning.
Yeah.
What was the response that you got both from, practitioners and the wider industry to your paper?
It varied widely. In some cases, I got hate mail and nasty comments from folks who perhaps these are perhaps from advisors who had been, telling their clients certain things for years and believed them. And then here comes along, this upstart advisor who's only been an advisor for a couple of years and says, sorry, no, that doesn't work. It's not 7%. It's not 2%. It's 4.5%. So I guess it must have embarrassed them in front of their clients, and they didn't believe my findings either. They said, how can that be? And then there are many other advisors who I was very grateful for, who saw what there was virtual value in what I did, and they were very complimentary, encouraged me to continue my research, which I really appreciated.
Did you have any idea that this was going to become, essentially, you were trying to move away from rule of thumb, right? And you dug into the data, and then someone, I assume journalists, somebody said this became the rule, the 4% rule, and then we ended up with another rule of thumb.
That's right. Well, to a certain extent, it's happening today. There are some folks who say, well, 4% or 4.5% is too much given the low rates of return. So it should be 3% or 2%, or I even heard less than 1%. But I haven't yet seen a scenario presented to me that, that supports that thesis, So I don't know what those numbers are based on. And that was true 30 years ago. And, the rules of thumb were there. And I guess things have to change.
So I want to move on a little bit, because you did extensive work on this. So there's a couple of different directions that I want to take this. One is, first of all, your views on expense ratios. So obviously in your original research and still ongoing research, you generally don't include the expense ratio because you use the asset class data. But of course, there is the expense ratio of the low cost index fund. There is the advisor fees, baked into all that. And how do you tend to approach that when you're thinking about the worst case scenario being, sort of 4.5%?
Okay, are you talking about investment management expenses essentially, or within the
Correct.
funds? Or well, it's interesting because when I started 30 years ago, there were actually, my research assumed that the investment expense would essentially be very close to zero, that the funds you use would track their indices exactly. And there were very few funds back then that could be set up. I think some of the Vanguard funds were relatively new. And I use them as a model. But today, of course, almost all the friction has been removed from the system. ETFs have practically zero management costs. You can buy individual stocks, but no commission. It's a great situation for investors and retirees in particular, because more of the money stays with them.
That's incredible. And then let's talk about asset allocation. So your original research was, 50% US large cap, and then, 50% intermediate government bonds. You then expanded that to cover small cap stocks, and that's when you sort of shifted from the 4% to 4.5%. Talk a little bit about the role of diversification of asset classes in the retirement portfolio and what that does to the withdrawal rate.
Sure. And I'm sure we could verify this. You developed some software, which I've been looking forward to test a lot of these ideas on. But I started out with 2 asset classes, and I added a third, and the small caps, and it significantly increased the withdrawal rate. And I always felt it was reasonable to assume that if you diversify the portfolio even further, as most advisors do, that you would be able to achieve even higher withdrawal rates. And that appears to be the case. What started out as a 4% rule became the 4.5% rule, and maybe is 5%. It might even be a little bit more than that today, So some folks are going one direction, they're going toward 3%. I'm going the other way. 5%. We're going to find out who is correct here pretty soon.
Well, 30 years so far, I think you're doing it pretty well, Bill. The other thing is on this, do you have any thoughts on this international or global diversification? Professor Wade Fowler has done some work on that side of things. Do you have any thoughts on what the likely impact on the withdrawal rate might be?
Yeah, I think if an investment adds diversification value, which means, there's a couple of things. There's the return it generates and also the correlation it has with other assets. But that's favorable, and that includes international stocks, more so than ever, because in this environment, they're much better valued. So emerging markets, international, I think are crucial for investors to have in their portfolio today, even if they don't immediately, generate an advantage over, U.S. stocks. I think U.S. stocks are so overpriced at some point. That's going to turn around.
Yeah, the way I tend to think about this is to say that, these international stocks might not add additional, performance necessarily, but as the sort of sustainable withdrawal rate framework is based on the worst case scenario, in the worst case scenario, it makes sense to think that they will provide some kind of downside protection in that particularly bad scenario.
Oh, I absolutely agree with that. I think you could actually verify that from my earlier research where I used just two asset classes. I noticed that when you combined, if you just use 100% stocks, you couldn't achieve that low withdrawal, that 4.2%. But when you add bonds, and bonds that return far less than stocks, they gave you that diversification value, and they raised the withdrawal rate, even though they're a much lower returning asset. So you're absolutely correct in that.
So one thing that comes up all the time, especially when we start to talk about, this framework, is people talk about cash. And I remember reading one of your papers where you said something to the effect of cash is trash. You tested these ideas of, well, what if I kept some of the portfolio in cash, and during periods of downturn in the capital market, I use that cash to draw on to fund my withdrawals. Do you have any views on that? Have you updated your thoughts on that side of things?
I didn't realize I had said cash is trash. And I beg forgiveness for that statement. That was a rash statement to make. Cash has its place in a portfolio. I think when I looked at bonds, whether you use long-term bonds or intermediate-term bonds, or substitute a lot of cash for the intermediate, it came out to be about the same effect on a withdrawal rate. So that having cash in portfolio, although, in this environment when cash is earning zero, bonds are earning not much more. I don't know if that's still true, but I think when valuations are high and there's concern about, a big stock market decline coming sometime down the road, I think having cash makes sense. Because for the retiree, rule number one is don't let your nest egg get stepped on. Okay, preserve that nest egg at all costs so you can fight another day. You don't want to get beat up by a 50 or 60% decline in the stock market early in retirement if you can help to avoid it. That's my view anyway.
Now a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. Can you sum up Betafolio's investment philosophy?
Our investment philosophy is really simple. We know that asset allocation drives returns, and we know that forecasting is rarely successful, and more often than not, it destroys value. And clients get the best results from owning the right mix of defensive and growth assets with a good level of diversification in the right proportions for their individual needs, and without overpaying for unnecessarily complex investment products. So we're kind of the Ronsteel of investment portfolio in a way. It just does what it says it does. It's uncomplicated, straightforward, with no bells and whistles. We want to deliver market return for clients.
Thank you very much, Nikki. So let's talk about, some sort of ideas about dynamic withdrawals and the impact of inflation. So first of all, the one major confusion that I find when I talk to people about the sustainable withdrawal rate framework is, this idea that the withdrawal rises in line with inflation every single year throughout retirement.
That's right.
And people will say things like, when they think of the 4% rule, they say they don't intuitively think about the impact of inflation, and that is baked into the framework. So I guess the question is, well, is it a fair assumption that people's expenditure will rise in line with inflation, or is there a case for, well, actually, if you don't increase the withdrawal in line with inflation, especially in bad years, then you dampen the impact of inflation on the portfolio, particularly in bad times. What's your thoughts on this idea of increasing withdrawal in line with inflation or not?
I think it's a natural tendency of humans to, when they're in a bad bear market and they're worried about their portfolio declining, that they will pull their ears and they will pull back on expenses. And I think that's good. There's no reason that you have to follow, the 4% rule and increase each year. If you want to take 1 year where you don't increase it or decrease it slightly, that could improve your chances later on. So yeah, I endorse that approach. I think it makes a lot of sense if people have the flexibility in their spending to be able to do that.
And is that the sort of thinking behind the floor and ceiling approach? So the idea that you can set a floor, of the 4% on your withdrawal, but maybe in years where the capital market is particularly generous, that you can actually maybe take more than 4% in those years.
Yes, yes, you could do that. In years which you just have to be careful about getting carried away with that, because you can have a couple of good years in a row with the stock market, like we did in the late 90s. You had 5 years in a row with 20% gains, and you get in the habit of taking bigger and bigger chunks. All of a sudden you get hit with an enormous bear market. Can you make that adjustment psychologically? So I think you can do that, but you have to do it sparingly.
Okay, so let's talk about your latest research, which you published in the Advisor Perspective. You've been looking at, the interaction between inflation and CAPE ratio or equity, valuation. Talk a little bit about that. What's the thinking behind that latest paper?
Yeah, it was very exciting for me this summer because I've been doing this research now for almost 30 years. And I had a lot of pieces in place to develop a complete, process for managing withdrawals. But there was a big hole at the very beginning where, most people said, well, let's take the 4.5% rate. We know that historically people have been able to take 7% on average, and some lucky people as high as 13. But there was no rational way to develop a basis to select one of those higher withdrawal rates. Well, finally this summer, I found a way. I started with some research another advisor had done some years ago, in which he said, look, when the stock markets are cheap, withdrawal rates are high, and the reverse. And I used that as a starting point, and I realized that if you added inflation in there at the start of retirement, if you had a low inflation environment, your withdrawals were higher. If you had a high inflation environment like the 70s, you had to take out less. And you combine the two of them magically, they had enough power to be able to predict what rate historically you could have used a very high degree of accuracy, close to 90%. And this was the last piece of the puzzle. This is the missing link. So now we can pretty well tell clients with confidence, some years, maybe when things get more reasonable in stock valuations, instead of 4.5, why don't you take 5.5? Why don't you take 6 or 7? Because, it indicates, it works, because if you look back at the bottom of the bear market in 2009 in March, when stocks were cheap and inflation was low, my new discovery indicated you could take 6.5%. And that's worked so far very, very well. Even though they're taking out more than the 4.5, their portfolio has grown dramatically in value. It's a healthy approach to it. So I'm looking forward to the day that we can use it.
So your thoughts on where we are today? Obviously, the market valuation is quite high today, but that's sort of mixed with very, very low inflation, although we don't know what inflation is going to do. But where are you in your thinking? If a retiree who is starting today, what would you be suggesting to them?
No, it's really tough because the situation we're in currently is really almost off the charts. We don't have any records of a 30-year period starting out with market valuations this high. So we can't be 100% sure, what rules to apply, but we do have low inflation going for us. So I think if people take 4.5 to 5%, they're probably going to be okay. But unfortunately, we won't know that probably for another 30 years, and then you can have me back in your program and tell me why I was wrong.
And then, of course, I think the powerful thing is that the 4.5% is a starting point. Clearly, there is a case for tracking that on an ongoing basis to see how that evolves, and then making a course correction, adjusting the withdrawal at some point,
right.
Along the retirement journey.
Yeah, it's important people realize that a retirement withdrawal plan is just like any other plan, or a estate plan and an insurance plan. They have to be monitored over time and sometimes adjusted if they no longer meet the original goals. And you're right, my method now basically consists of identifying some year in the past whose starting conditions were very similar to what the client is experiencing, and using that as a template, which they can then measure their progress again year by year for 30 years. And if they deviate from it, they may have to take the last time, even take more if they're doing much better than the template indicates. So it's a two-edged sword.
Do you have any thoughts about bond yields? I have read and defended your work, but I've read several different articles essentially saying, well, because we're in an environment where bond yields are historically low, they're lower than they've ever been, certainly in the last 30 odd years. Therefore, the 4% rule can't hold anymore. Do you have any thoughts on the impact or the likely impact of bond yields on sustainable withdrawal rate?
Well, the possibility is that they could be correct. Okay, but I have yet to see a specific scenario presented to me which reflects their views on hard black and white numbers on a sheet. And until I see that, I'm going to say they're doing qualitative criticism, but the quantitative criticism is the one that really will convince me, and I haven't seen that yet.
The other thing that the other criticism of your work that I come across a lot is, talking about the use of Monte Carlo simulations as opposed to historical returns. And I've always thought this to be odd, right? Because I say, well, Bill's work is based on, empirical data, right? Observed data, and we can extend that data even for longer if we want. But this idea that we can plug assumptions into Monte Carlo simulations. I put in expected return and inflation, and somehow think that that is more potent or that's more powerful than observation, historical observation of return over the last 100 years. I don't understand how that can be more powerful, but there you have, but there you go. People make these, these comparisons between, historical returns and simulated returns based on these models. Do you have any thoughts or counter arguments on that?
Yeah, I do. The Monte Carlo and similar approaches have their place in financial planning. There are almost some applications where you have to use them, but you have to be very careful because they're basically models of actuality and not actuality themselves. So if you don't specify, the input variables and the relations between them, you may end up with some output which may make sense in the context of what your model, but may never occur in reality. And if it doesn't have a chance of occurring in reality, it's kind of worthless. So I would say that they're useful, but neither method, neither theirs or my empirical method, has any predictive ability at all. We cannot predict the future. All we can do is look at the past. That's all I do, basically. And I'm like a reporter. I'm going to the past and saying, this is what happened. I'll let you know. I don't know what will happen in the future, but in case you wanted some guidance from the past, I can give that to you. And they're doing the same thing, except they're able to test, many, many more scenarios that I could possibly do than I have available to me. The question is, are those scenarios real? Could they ever occur in the real world?
Yes. No, it's incredible. I like the position of humility that you approach this with, to say, well, look, we don't know what the future is. We can't predict the future. All we can do is to, stress test what your plan based on observation of, based on the weight of history, and offer some guidance and track things and see how they evolve. I think that's an incredibly powerful approach. Now, I want to just to start to wrap things up here, Bill. So you're retired. You've been retired now for a number of years. So tell us about it. What's retirement been like for you?
Well, it's hard to call it retirement. I retired from financial advising, but now, I spend a lot of time researching the 4% rule. I've written 3 novels. I'm trying to get them published. I have a young grandson which is one of the main reasons I retired, because I want to be a good grandfather. I want to have time for him. And now the COVID comes along. It's hard to see him. But that's a very busy life. Almost every day, I try to do something creative, try to learn something new. I like to play tennis and golf, but, not that alone. There are a lot of other things in life. And retirement is wonderful in that sense, because I don't think of it as retirement. I think it's just a whole new phase.
I totally agree. It's incredible. So how have you managed your own portfolio throughout this time?
Well, I used to be buy hold investor in the 80s and 90s. And then we got into that first bad bear market in the early 2000s. I've seen increasing involvement in central banks, including our own Federal Reserve, and the markets. It's you wonder whether the markets really can be called markets anymore, because price discovery, has evaporated. But I feel that I can no longer be buy and hold investor when there are so many outside forces impacting markets and creating huge swings. We've had some pretty big bear markets. The last 3 have been 35 to 50% or more, 55%. That's never happened before historically. It's pretty amazing. And I think I don't really like to sit there and watch my portfolio pounded by a 50% bear market. And I have a saying that says, with all these hammers we have hanging over our head, we all don't have to behave like nails. We can go out and do other things. So I manage my investments actively. I will reduce my exposure to equities when I feel risk is high. I think risk, certainly in the United States, is high today, so I don't have my full allocation right now. But I'm looking forward to the opportunity when those valuations improve, and I can very aggressively get back into stocks, because I still think they're long-term, they're the foundation of investment wealth for most people.
So this is interesting. The guy who taught us all to be buy and hold is actually, shall I say, a closet market timer. So let's
Oh, no, you're using that nasty term. I like to use risk manager.
Risk manager. Let's unpack that a little bit. So I assume that you use index funds, but you time
yes.
You time your allocation to the market.
Yeah, although I'm very interested why people think that I recommended buy and hold. I used buy and hold approach in my research because it was the easiest way to analyze investments, because there are so many different ways to manage risk. It'd be difficult to do it in a uniform fashion. But over time, personally, yes, I've become more active and more risk oriented and not passive. No question about it. And I think
how's that worked out for you? Are you happy the way, because I look at certainly the last 10 years, yeah. Even including the recent market downturn that we have in March of last year, the market rebounded very, very quickly. And so if you were sitting in cash, I know you're not completely in cash, but, if you're sitting with a substantive proportion of your portfolio in cash throughout this period, you must be looking at the S&P 500 and wondering, oh gosh, I missed out on quite a little bit of return there.
Yeah, I'm not concerned about missing out on return. I'm concerned about protecting my nest egg. You want to watch out about that fear of missing out syndrome. Back in March, before the bear market hit, I was only about 10% equities. So I only lost about 4 or 5% of that bear market. Okay, but as the market went down, I bought. So I came out. I didn't buy as much as I would have liked because it never got to the valuations that were truly appealing. But I ended up with about 25 to 30% equities. So I went up a lot faster than I went down, and I'm happy with that because I made enough, to finance, and that's really what counts, that you make enough to finance it, not that you get every single last penny out of the market's return. I think that's a dangerous way to look at it.
Do you see, actually, this is interesting. Do you see, so obviously the overall market, if you're looking at valuation, the overall market, the valuations on the high side historically, yeah. But do you see pockets where valuation might be quite attractive, maybe international, maybe even sort of value type stocks? Do you have any views on that side of things?
Yeah, I think definitely international valuations are better in equities than they are in the United States, particularly emerging markets and emerging market bonds and emerging markets value stocks. I mean, you could almost load up on them with impunity and have good returns over the next 10 years. Well, the expectations for United States stocks may be flat or negative for the next 10 years when you get to these levels of valuations. So yeah, there are places where you can find value, hide out, but we'll have to see. I mean, this market just keeps wanting to go up and up, and these are the dangerous times for investors, to get pulled into it and get fully invested and then get clobbered.
I guess there's another dimension to the sustainable withdrawal rate research that you're bringing up in this, and which is what happens when you use market valuation in not just to manage your withdrawal because you have control over that, but you use market valuation to to gauge your allocation to the market.
Sure.
And I think that's an interesting perspective to the research. I might have seen at least one research on that is using sort of market valuation to manage allocation to equity. But I guess what you I'm trying to recollect that research is you
Sure.
find very long periods that you will be sitting in cash.
Yeah.
And from a behavioral standpoint, just to say, well, look, the CAPE ratio is in the top decile historically, and therefore I'm going to avoid equities or limit my equity exposure. It's a very, very difficult thing to tolerate behaviorally, because you're going to end up sitting in cash for a very long time. And
well, that's true. And I don't use valuations solely as my indicator. I have subscribed to some services. I use a combination of technical momentum indicators as well as valuation. But I think you could use the valuation only and do okay as an individual. As a professional, it's probably, the career risk problem where you sit in cash for 5 or 6 or 7 years, and all your clients see their neighbors getting rich and they become upset. And it'll turn out you'll be right, because there have been periods of time like the 2008 crash. You could have been in treasuries for 13 years, and you would have dramatically outperformed stocks over those 1996 to 2009. So it works, but it's just difficult for professional investors to do it because of the nature of human emotion. So if they're going to do it, I think they need to use some moving average, some combination with technical momentum indicators. And I think you can get better results, lower risk anyway, which, I think most of my clients appreciated the lower risk approach.
Bill Bengen, it's been incredible talking to you. When we started this conversation, I couldn't have guessed that we would end up talking about market valuation and active management or risk management, as you call it. So it's been a fascinating conversation. Thank you very much for your time. Thank you for your wisdom. Thank you for all that you've done for the profession. I guess the final question I have for you is there anything that you'd like to talk about?
Our profession seems to have a single-minded devotion to buy and hold, and I don't understand why completely. I think the profession needs to give itself a chance to examine alternatives, at least study them, or provide justification for a buy and hold approach. It's a valid way to invest, but it's not the only way. I hope at some point there'll be enough open-mindedness among practitioners to consider alternative ways, because I think they'll benefit from it. I think their clients will perceive they will be adding value by doing that.
Well, if you keep talking about it, maybe more and more people will listen.
Yeah. Well, who knows? Who listens to an old man, retired man?
We do, Bill. We do.
Final thoughts. I still continue my research, and I hope in future years to have more results to share with folks, to help them in this particular area. There's a lot to be uncovered yet, in my opinion. I'm like an archaeologist, like Indiana Jones of finance, trying to dig things up, interesting nuggets.
Bill Bengen, thank you for your time. Really appreciate it.
Thank you too, Abraham. It was wonderful.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together, led by my producer, Hannah Dickinson. Thank you very much, guys. I'd like to thank our sponsors, Timeline App, the retirement planning software, and Batefolio, the high-tech, low-cost flat fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.